Imagine this. A company misses their quarterly earnings per share target by nearly 16%. In a normal market, that kind of headline miss is a recipe for an absolutely brutal sell-off. Yet almost immediately after Sea Limited's numbers dropped, the stock instantly popped almost 10% in pre-market trading. It's a massive disconnect, right? Well, to understand why Wall Street completely ignored that bottom-line miss, we have to look under the hood.
To figure out why this stock actually surged 9.58% to $125.80, we have to look past that headline EPS miss and unpack the hidden economic engine driving this business right now. You see, what the market saw wasn't a company failing to generate a profit. They saw a company deliberately shifting its entire operating model. But to really grasp the magnitude of this shift, you've kind of got to understand the sandbox Sea Limited is playing in. We're talking about Southeast Asia and Latin America. Specifically markets like Indonesia, Vietnam, and Brazil. These are regions with massive, young, rapidly digitizing populations. We aren't talking about tens of millions of people here, we're talking about hundreds of millions of consumers entering the middle class and coming online for their daily transactions. Sea Limited recognized early on that winning these markets wasn't just about selling things online. It was about building the underlying digital infrastructure for regions that historically just didn't have it. And that context? That is exactly why this recent 10% pop makes perfect sense when you dig into the actual mechanics of their business.
Okay, let's dive into this triple-engine flywheel. Sea Limited isn't just an e-commerce company, and it certainly isn't just a gaming publisher. They operate what is essentially an integrated digital ecosystem across these emerging markets. You have Shopee, the e-commerce marketplace, you have Monee, the digital financial services arm, and you have Garena, the digital entertainment and gaming division. Now, you might be wondering, why is an integrated ecosystem so absolutely vital here? Well, in mature markets like the US, you have legacy banking, established credit bureaus, century-old logistics networks. But in emerging markets, a massive portion of the population is underbanked. Credit cards aren't ubiquitous. Delivery infrastructure is totally fragmented. So Sea Limited didn't just build an app. They built a whole closed-loop consumer transaction cycle to solve those infrastructural gaps themselves.
Now here's where it gets fascinating. How do these three engines actually fund each other? Here is the true economic cycle at play. Garena generates massive, highly profitable cash flow from its hit mobile game Free Fire. That gaming cash is then funneled over and reinvested to build out Shopee's in-house logistics network, SBX Express. That logistics density makes shipping incredibly cheap, which in turn draws in over 400 million active buyers. Those buyers and sellers then generate a literal mountain of transactional data. Finally, Monee steps in. It uses that precise, proprietary data to underwrite a highly profitable $11.1 billion credit portfolio. It's a perfectly integrated loop. The gaming funds the commerce moat, the commerce creates the data, and the data creates highly profitable financial products.
But, there is a central conflict here. It's the exact thing the market has been terrified of over the last few quarters: competition. ByteDance's TikTok shop and PDD's Temu are aggressive, they are incredibly well-funded, and they are looking to dominate these exact same emerging markets. And their playbook is brutal. They're totally willing to burn billions of dollars in cash, heavily subsidizing items, and offering extreme discounts just to buy market share. But Shopee has built a structural defensive moat. While competitors try to win on aggressive, unsustainable pricing, Shopee wins on localized logistics density. They've already built the warehouses and the fulfillment centers, meaning they deliver faster and cheaper on a unit economic basis. This moat is so strong that instead of cutting prices to survive the onslaught, Shopee has actually been able to raise its marketplace take rates to 14.6%. Think about that for a second. In the middle of an intense promotional war with giants like ByteDance, Shopee isn't just surviving, they have the pricing power to extract more value from every single transaction. And this brilliantly illustrates the exact evidence from the Q 2026 earnings that the market reacted to. The company reported adjusted diluted earnings per share, or EPS, of 70 cents. Now, that was a 15.66% miss against the 83-cent consensus Wall Street was looking for. Normally, a bottom-line miss like that sends a stock plummeting. But look at the top line, the actual sales coming in the door. They delivered a massive $7.79 billion in GAAP revenue, crushing estimates by nearly 10%. The market entirely ignored the EPS miss because that bottom-line drop was driven by higher tax expenses and conservative provisions for credit losses in their financial arm. It just wasn't an operational failure. The top-line GAAP revenue growth basically proved the underlying ecosystem is expanding right on through the competition.
But honestly, the real catalyst, the thing that fundamentally changed how investors are pricing the stock right now, was a change in guidance. Management explicitly stated they expect higher absolute EBITDA in the second half of 2026 compared to the first half. That represents a massive strategic shift. They are essentially moving away from their previous era of aggressive cash burn market share acquisition to a new era of self-sustained profitability. This means they no longer need to rely on external capital markets or debt to survive and grow. Their own flywheel is generating enough cash to fund its own expansion. And hey, by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed.
So let's synthesize this into a qualitative scorecard. When we do, the structural quality of the business becomes super obvious, landing an overall blended score of 8.1 out of 10. Let's break down why that score is so robust. Their market position in Southeast Asia is dominant, earning a 9 out of 10. They aren't just a participant, they are the incumbent infrastructure. Their financial health, also a 9 out of 10, is arguably their greatest asset right now. They're sitting on a fortress of $10.5 billion in cash and short-term investments against just $2.0 billion in debt. That means they can outlast almost any subsidy war. We also look closely at capital allocation. Management is earning an 8 out of 10 here because they're actively executing a disciplined $1.0 billion buyback program to manage shareholder dilution, which really signals that they believe their own stock is undervalued. Overall, this qualitative picture shows a mature management team beautifully transitioning a high-growth tech platform into a highly profitable, self-funded compounding machine.
Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Moving on to the 5-year scenario framework, visualizing future economics. Now, right up front, I have to state clearly that this next section is a hypothetical framework for thinking about possible future outcomes. It is not a prediction, and it is definitely not financial advice. The stock could go much higher or much lower than any of these scenarios. The goal here is really just to answer one specific question. If the business develops in these different ways, what might the stock plausibly be worth 5 years from now, in 2030?
The crucial point here is understanding the operational assumptions behind these revenue models. The base case assumes $55.65 billion in revenue by 2030. Operationally, to get there, that requires a 16% annualized growth rate driven by successfully scaling high-margin ad auctions on Shopee, essentially getting merchants to pay more for visibility. The high case shoots all the way up to over $74 billion. But for that bull scenario to happen, Shopee has to scale massively and profitably in Brazil alongside its core markets. They'd basically have to replicate their Southeast Asian dominance in Latin America without burning all their cash to do it. On the flip side, the low-case model's revenue at just $44 billion. What causes that? Well, that happens if those intense promotional wars with TikTok, Shop, and Temu escalate. If competitors refuse to let up, it could force Sea Limited to constantly compress their margins, subsidize shipping, and burn through their cash reserves just to survive and keep their users.
So, when we attach valuation multiples to those operating outcomes, we get our 5-year future targets. In our 55% probability base case, assuming an 11.5% EBITDA margin and a reasonable 12x exit multiple, the implied future share price is $144.97. But I really want you to look at the massive gap between the extremes here. The high case could take the stock all the way up to $325.57, while the low case drops it to $44.67. That is an incredibly wide spread, and it perfectly highlights the massive volatility and risk inherent in emerging market tech. Success means exponential compounding. Failure means severe margin compression. If we probability weight these 3 scenarios based on the research, the 5-year expected future target sits at $170.05. But remember, that implies management successfully scales ad take rates and maintains strict credit underwriting in Monee over the next half-decade.
Intrinsic value, discounting the future to today. So we've looked at possible destinations 5 years out. But there's another question, and arguably it's an even more fundamental one. What are the cash flows this business could generate actually worth right now? This is our intrinsic value analysis. It's built on a very intuitive concept. $1 of cash generated years from now is simply worth less than $1 in your hand today.
So we have to discount those expected future cash flows back to the present.
To figure this out, we start with the operating engine. We are anchoring this discounted cash flow, or DCF, directly to our base case assumptions. We're assuming they start 2026 with $31 billion in top-line revenue, and over the next 5 years, they manage to grow that by 16% every single year through 2030. The trajectory we're modeling here shows margins steadily expanding from a starting point of 7.5%, climbing up to a 10% operating EBIT margin by year 5. That happens as their advertising and digital payment efficiencies really start to kick in and scale. At the same time, we assume the share count remains perfectly stable at roughly 612.48 million shares, meaning their ongoing billion-dollar buybacks are effectively offsetting any stock-based compensation given to employees.
Then we apply our discount rate, or weighted average cost of capital, which is set at 10.0%. Think of this number like an essential hurdle placed on future cash flows, because C Limited operates in emerging market economies with all the associated currency volatility and geopolitical risks, and because current interest rates set a fairly high baseline for capital. Investors require a robust 10% annual return just to justify taking the risk on these future projections. But obviously, the company doesn't just vanish after our explicit 5-year forecast ends. We have to calculate a terminal value to estimate the mature state period post-2035. The model assumes a 3.0% perpetual growth rate from that point onward. Why 3%? Because that roughly mirrors long-term global GDP growth, which makes it a really realistic anchor for a mature infrastructure company. It is absolutely critical to understand that this terminal value makes up over $35 billion of the company's enterprise value in this model. That means this intrinsic valuation heavily depends on C Limited's long-term durability and survival in the Southeast Asian economy, literally decades into the future. Let's build the valuation bridge right now, step by step, so you can see exactly how the future transforms into today's price. First, the present value of our explicit cash flows over the forecast period equals $18.75 billion. Then, we add the present value of that terminal value we just discussed, which comes out to $35.02 billion. Combining those gives us our enterprise value. Next, we add back their massive $8.5 billion net cash position, and finally, we divide that total implied equity value by their 612 million diluted shares.
And that math brings us to a base, implied present intrinsic value of $101.67 per share. But let me stop right here and warn strongly against false precision. A DCF is not some objectively correct answer spit out by a crystal ball. It's simply a mathematical reflection of the human assumptions we just made.
To see how fragile or robust that $101.67 estimate actually is, we use a sensitivity matrix. The value swings wildly based on your outlook. For instance, if you are highly conservative and demand an 11% return, while only granting 2.5% terminal growth, the intrinsic value drops all the way to $83.45. On the flip side, if the discount rate is lower at 9% and terminal growth is slightly higher, the intrinsic value climbs up towards $128. By looking at these varying combinations, we establish a reasonable present intrinsic value range for C Limited, sitting right between $85 and $125 per share. All right, here's where it all comes together. How do we reconcile these numbers? The current stock price is $114.80. Our base present intrinsic value is $101.67, and our 5-year base case is $144.97. Are they disagreeing? Not at all. The current stock price of $114.80 requires a slight premium to our base intrinsic value, mostly reflecting the short-term market momentum following that huge Q2 revenue beat. But it remains significantly below the $144.97 future scenario value due to the time value of money and the compounding we expect over the next half-decade. The two lenses are telling the exact same economic story. The market is pricing in the growth, but leaving some room for the execution risk.
But look, to actually reach that future, C Limited has to navigate some very real thesis-breaking risks that could fundamentally break both the scenario models and the DCF. As investors, you need to watch for specific early warning signs. If the 90-day non-performing loan ratio in Monee rises above 1.5%, that is incredibly dangerous because Monee's profits literally fund the rest of the flywheel. If that credit underwriting deteriorates, the whole system gets stressed. If Shopee's ad take rates start declining sequentially, it means merchants are losing faith in the platform's return on ad spend and they just aren't willing to pay for visibility anymore. And if sales and marketing spend surges back to previous highs, it means TikTok Shop and Temu are forcing Shopee into a margin-crushing subsidy war, which would instantly destroy those expanding margins we modeled out earlier.
So will C Limited's triple-engine flywheels successfully scale margins without sacrificing their dominant market share? That is the ultimate question here. The market completely ignored a 16% earnings miss because the top-line revenue and the underlying cash flow trajectory proved that their transition to self-funded sustainable profitability is actually working. The engine is humming. Now, if you want a full research, including the complete 5-year scenario model and intrinsic value analysis behind this explainer, you can get it totally free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.